Well, thank you so much for having us. My name is Emma Davidson. This here is Miles Staude. I am the CEO of a company called Staude Capital. Miles is the CIO, and our business runs the Global Value Fund listed on the ASX. Allow me to just spend a few moments talking about the Global Value Fund and what we've done over the last 11 years. From there, Miles and I are going to talk a little bit about the big picture, just give you our thoughts on what we're seeing. And then we want to talk about these two tectonic changes that we've really started to get some traction over the last 10 years and that are starting to accelerate. And we want to bring that to your attention as well. Just starting with the GVF update, I think I'll just spend 2 minutes talking about what we do. You know, if you're new to us, the first thing that the Global Value Fund looks for when making an investment is a discount. Trading at a discount is when the share price of a company trades below the assets of that company. In Australia, there are about 100 or so of these companies that have ability to trade at a discount. Globally, there are thousands. The market cap of that industry is about $600 billion US. Now, we specifically go into these structures and we're looking for that discount and a catalyst to unlock that discount. So it's not just hope, we want to have a catalyst. And the second thing we look for is we want to diversify the underlying assets that we end up holding. So that discount plus diversification are the two most paramount important aspects of the strategy. And in the time that we've been going, 11 years, we haven't had a single down year running the strategy that we've been running. There are only 8 other products in the Lonsec universe that can claim the same. We've annualized at 11% per annum over that time period. And I would argue that we've outperformed across the board. Now, that's a very big statement, and I will qualify it. I think the best way to think about it is maybe to compare us to equity markets. It's important to remember that over the 11 years that GVF has been running, we've only actually been 30 to 35% exposed to global equities. But I'm going to compare us to equities nonetheless because it's been such an incredible area of growth. Over the last 11 years, Australian shares have annualized at 10%. The US has annualized at 17% per annum, and global shares have annualized at 13%. Now, equally important to the returns that you made is the risk that you took to get those returns. The highest volatility there came from Australia. US shares was 12%, global shares was 11%. And volatility is generally the most common risk metric we use to decide how risky something is. If you then divide the returns by the volatility, you get what is called a Sharpe ratio. But very simplistically, a Sharpe ratio simply shows you the quality of the returns that you've received. The higher the number, the higher the quality of returns. And you can see there, Australia, has a Sharpe ratio of 0.58. A Sharpe ratio over 1 is very unique and quite rare. You can see the US has run with a Sharpe ratio of 122, so it has the highest quality of returns over the last 11 years. Global Value Fund, we have run at 11% per annum, but crucially, we've run with that much lower volatility, which has actually given us the best Sharpe ratio of the lot, so the highest quality of returns. I wanted to look at a few more things. Credit is something that people are talking a lot about in Australia, so I looked at that market as well. I looked at the top names that always come up, CSL, CBA, BHP, looked at how they've done. Property, what is a conference without talking about property? So I've got some A-REITs in there. I've also got some CoreLogic data. Noosa Heads happens to be the best performing area over the last 11 years. So I've put that up there as well. And then just 2 funds that we get talked about a lot. So Plato and Teleria. And if you take all that data and you kind of sort it in order of the quality of returns, hopefully you can agree with me that the Global Value Fund has kind of outperformed across the board with the highest quality of returns. I mean, that's kind of us just giving you a quick summary of where we are, how we've come to be after 11 years. I might hand over to Miles now just to run us through the macro, what's going on in the world and what are we seeing?
Thank you, Emma. Emma's far too modest to tell, but today's actually Emma's birthday. She's 21 again today.
Oh, wow. Thanks. Yeah, thanks. Thanks, guys.
And hopefully we'll finish off tonight, go out somewhere for dinner. But look, so whenever we do these presentations, Emma always says, look, you know, you and the team sit in the coalface in London, come out, tell us about the big picture. And I guess I always do my best. The caveat I'd make is I don't have a crystal ball. Nobody has a crystal ball to kind of predict the future. I guess we do have some interesting insights being at the coalface every day with markets, and all I'm trying to do is share those with you. We don't take big macro bets in the GVF portfolio. So hopefully investors that know us now understand that it's a relatively conservative investment portfolio. We try and punch above our weight in terms of returns for the amount of risk that we're running with. But we obviously have to be aware of the big picture, and we do have to manage it in the portfolio some time. And I guess just to start us off, I mean, it's a fascinating time to be around. Like whether we fully understand it or not, we're currently living through one of the biggest investment booms in history. This year, America's tech firms are going to spend $400 billion developing artificial intelligence models. That's $400 billion US dollars. And that's really the thin end of the wedge. That number has been accelerating over the last few years and is expected to accelerate over the next few to come. The numbers that I've seen most recently say that US tech firms are going to spend $3 trillion US dollars over the next 3 years building out AI models. And that's to kind of put that into context between what's being spent this year and what's coming down the horizon over the next couple of years. That's 2 times Australia's annual GDP being spent on developing AI. And while the Americans are at the front of the curve, you know, the leading edge of artificial intelligence, they're not the only game in town. China's spending vast amounts on AI, as are lots of other European countries and other countries out there. So there's clearly a massive spending boom going on, one that I think a lot of us sort of day to day don't quite appreciate. Now, what is AI? I know a lot of us are still struggling with what it's all about. I know, you know, in my own life, it's probably its biggest use today is it helps with the kids' homework. But
it's worrying when our kids are 8, 6, and 2.
I know. Then we need help.
You need help.
But for the AI boosters, I think the thing that everyone's chasing at the moment, why so much money is being spent, is this concept of AGI, artificial general intelligence. So there's a big arms race going on at the moment to see who's going to be the first firm to develop models that are basically as good or better than humans at thinking jobs. And the first firm that does achieve that is going to walk away with an incredible kind of investment prize. If you think about how dominant Google is in internet search and how profitable that business is, or you think about Facebook, how dominant it is in social media and how that's just a massive cash cow. What's essentially going on at the moment is there's a massive arms race between all these big tech firms. When they see the prize, the one that establishes itself as the AGI player. So that's all interesting. Vast amount of capital being spent. What does that mean for markets? What does that mean for what's going on? Well, just to kind of bring ourselves back, 6 months ago when I was out talking to people around Australia, the big preoccupying force in the market then was Donald Trump. So his return to the White House had been rather unorthodox. His tariff policies that announced particularly, and along with a lot of other kind of economic policies he was putting out, were incredibly unorthodox. And whether they're right or wrong or not, that's not a political statement. Most economic forecasters expected the US economy to start doing it very tough. The big protectionist lurch the US is going through under conventional economic models should be very damaging for growth. So not long after April, most forecasters, professional forecasters, were lowering their growth targets for GDP growth this year and next year. If you remember, you would have seen a lot of people saying the US might actually slip into recession. Fast forward to today, October, nearly November, that clearly hasn't happened. The US continues to grow at an incredible rate. What's going on? Well, we can see the numbers now. So for the first half of this year, US GDP was 1.6% annualized. And that's a little below the kind of 2% figure you would have expected before Trump started announcing some of these policies, but well ahead of most of the other rich world countries in the world, and certainly well ahead of, you know, recession level. What's happened? Well, what's happened is it's become increasingly clear that as the year has progressed, this massive AI capex boom is overshadowing what Trump's been doing. He's really been given a complete free kick. And I don't think the nuance at this point will ever get discussed widely at the White House. But if you drill into the first half of this year's growth numbers now, what I find really fascinating is that if you take out this one-time effect from CapEx from big tech firms, and it is a once-in-a-generation kind of splurge, if you take that one-time item out of US growth figures, the US economy didn't grow at all in the first 6 months of this year. And what I find really fascinating about that is we're obviously aware that markets are incredibly frothy. There's a huge amount of exuberance going on out there. And if you juxtapose where we might have been if the US had been flirting with recession for the last 6 months, I think it's a really interesting kind of thought experiment. And more importantly, I think it sort of tells us where we are today. Not only are these big tech stocks driving financial markets higher, dragging all the indices they're part of higher, they're increasingly carrying the real economy with them. Most of the economic growth we're seeing in the system at the moment is coming from capital expenditure from tech stocks. Now that begs the obvious question, which I'm sure you would have seen talked about in the papers. Are we heading towards a bubble? So has the hype around AI gotten ahead of reality? You can see on this chart here the makeup of the S&P 500 index, or rather the proportion of the S&P 500 index that's accounted for by technology stocks and communication stocks. And as the Magnificent Seven or all those FANG stocks have done so well in recent years, you can see that now they've done so well that they've become an increasingly big part of the index in total, and they now make up 40% of the entire S&P 500 index. Same peak that we were at the top of the dot-com bubble. Now those kind of charts and those kind of articles you read about in the paper certainly adds a lot of weight to this idea that maybe we're in bubble territory. I'm going to try and present a more balanced, a more nuanced kind of proposition. And I think, in my view, I think the risks are more equally balanced upside and downside. And I think the thing to take away, I mean, it's obviously very worrying. We're seeing this situation where vast amounts of money are being spent by these big tech firms. These tech stocks like Nvidia or Amazon have had an incredible run in terms of performance. And on a lot of traditional valuation metrics, they do look expensive, though those are not the bellwether for how you might actually want to value these things. Altogether, that's obviously very worrying, but it doesn't mean there has to be a crash coming around the corner. It's a truism to say that the only time you really know when a crash is coming or has come is after the bubbles burst. I'm going to put this little chart up here now. And this shows the NASDAQ index. So this is the main index of technology stocks in the US. And why I think this is interesting is this is a template that you see a lot of people referring to today. So this is the NASDAQ index, US tech stocks, through the dot-com boom of the 1990s. It's not a perfect template for what's happening today, but it's not a bad analogy. You had a period where a revolutionary new technology came along, the internet. You think about how ubiquitous it is today. In the 90s, it was burgeoning. And again, you had vast amount of capital being spent, particularly by the telco stocks, pushing this kind of revolution out. And you also had a period where, for a very long period of time, people were calling a bubble, all through the late 90s, all the way to the end of 1999. And they were obviously ultimately right. But along that journey, the NASDAQ doubled, then it doubled again, then it more than doubled one last time just to rub it in. And I think the thing to note is it was a very volatile ride. You had 7 drawdowns and more than 10%. But if you were ever able to get in and out of this and call the timing of it right, I would assert it was complete luck. There was no skill in it. I think we always have to remain very humble when we're trying to navigate markets like this. For what it's worth, and I guess the message we've been going out to investors with, it's obviously a very tough time to be an investor. There's a lot of FOMO. Everyone wants to own some Nvidia. Everyone wants to not miss out on the excitement. And when we're trying to juggle between the FOMO on one side and, shall we say, the faux woe, the fear of getting wiped out on the other, the 83% drawdown, there's perhaps 3 principles that I guess are helpful and that we certainly hang on to. The first is that, given the amount of hype, given the amount of money that's being spent, this is just my view on life, but I think it would be normal and reasonable to assert that there will be an over-exuberance phase. And I personally, I don't think we're there yet. We haven't really had the big blow up yet where everyone in the world is chasing anything that's got anything to do with AI. I think we'll have an over-exuberance phase. There probably will be a shakeout after that. I don't think you can spend $3 trillion in 3 years and expect everyone to make a return on that money. But the more important counter to that, and something that I've always taken to heart over my time of investing, is that we really shouldn't be in the game of trying to call time when the markets turn. We have to be humble and remember that no one can correctly time the market. Hopefully, you all have a plan that's a much longer time horizon than what the next 1 or 2 years in the markets is going to look like, and you're managing your risks and you have a destination in mind. The old adage I always say is old for a reason, and that is, it's about time in the market, not trying to time the market. And then the last insight I'd throw, which is again a little bit counter to what I was just saying, in the sense that it's probably makes some sense to be relatively relaxed about what's going on in markets as long as you've got a portfolio that's suitable for yourself and all weathers. This last point I want to make, and this is one that's going to tie in with the theme Emma's about to talk to. There's been a massive change in the structure of financial markets over the last 20 years. 2 big drivers, we'll talk about them in a minute, but one of them has been the incredible growth of passive investing. So people investing directly into indexes using exchange-traded funds. And they've been a wonderful innovation in finance, but like anything, it just gets sold and sold until there's a problem. And I can see a problem building. And I guess what I'd say here is that the market has become incredibly distorted. So what's left of public share markets has become incredibly overshadowed by the success of these tech stocks. When you have a situation where 40% of the S&P 500 is made up of just a handful of high-risk, high-reward stocks, I think it's honest and fair and true to say that an investment in the S&P 500 today is just a much riskier proposition than it was 5 years ago. You're probably getting paid for the risk. It's probably fairer to say it's a higher risk, higher reward proposition, but it is a far less diversified, far higher risk proposition than it was 5 years ago. And I think the final message I'm trying to leave our investors with is really to say that these tech stocks are incredible and they're exciting, but you shouldn't accept as default the very high weighting index providers gives to them now. I don't think it's appropriate for people in their 60s and 70s to have 40% of their portfolio invested into high risk, high growth tech stocks. That might be great if you're 21 and you've got a lifetime ahead of you to compound and save, where you should be taking high risks. But if you're 61, if you're 71, I don't think that kind of weighting is really appropriate for every investor today. Anyway, those are my best attempt at the insights, and I'll hand back to Emma.
So whenever we come out to Australia, we try to be interesting, which is not that easy to do. This time, we're going to talk about 2 tectonic changes that we see taking place. This is not, I want to be clear that we're just trying to be educational and interesting as opposed to having an agenda with this. But it is something that has been changing gradually over the last couple of decades, and it's something that we want to spend a bit of time on. And the 2 themes are, first, the exponential growth of the passive industry, and secondly, the incredible growth of private markets, which has meant the kind of subsequent disappearance of public markets. I'm going to start with the exponential growth of the passive industry. I'm just going to rewind a little bit back to where it all started. In my opinion, the thesis of passive investing or ETF investing goes back to the efficient market hypothesis, which is a hypothesis that was brought about in the 1960s. And the hypothesis states that everything you could want to know about a share price or indeed a currency or anything in the financial markets is already known before you pitch up and try to buy that stock. Historically, the way financial markets have worked is that we've had teams of analysts crunching data, building models. We've had economists examining balance sheets, examining company accounts, and all that work and all those people all over the world goes into working out the fair value of financial assets, whether it's the value of General Electric or indeed the value of the Australian dollar in international markets. Everything you could want to know is already in the price before you turn up. Now, in 1975, Vanguard took that hypothesis one step further, and Jack Bogle said, well, if everything's already in the price and all these people are already doing all this analysis and all this work, why don't we just launch an index tracking fund and basically use all of that information for free? So the passive sort of revolution was started, and it was brilliant. Everybody out there was an active fund manager doing all that work. The Vanguard S&P 500 tracker fund was simply tracking those companies. And, active fund managers really just didn't stand a chance when it came to the passive copycats. And if you look at what the S&P, one of the major index providers, they started tracking this, how are active fund managers performing versus the indices? And unfortunately, the data was quite damning. I've got two examples here. The US now makes up almost 70% of global financial markets, so it's hugely relevant to all of us. And of course, Australia. And there on the screen in front of you is, in the light blue, is all the active fund managers who have done worse than the S&P 500. And in Australia, the light blue, all the active fund managers who have done worse than the S&P's ASX 200. And as you can see, that is over a 15-year period. And so the summary has been for a very long time, just buy passive. Why bother with these active fund managers and their high fees? And that has led, 2 years ago, globally, the passive industry became bigger than the active funds management industry. And as of this year, the passive industry is now bigger than the US market's active fund management. And it kind of led us to this question of, okay, so if more than half the market is passive, who's doing the analysis? And how efficient is that efficient market hypothesis now?
Thanks, Emma. So look, as Emma set out, the last 20 years, and this is just a thought piece. So there's no actionable point to worry about tomorrow. But I do think the structures of markets have changed enormously in 20 years. I don't think a lot of people quite realize the changes that have gone on. And I think these themes we're talking about are just accelerating. So those two big themes, enormous growth of passive investing. There's now more passive money in the market than active money. It does ask a really interesting question. The efficient market hypothesis is based on the idea that there's active managers out there making markets efficient. That obviously can't work in a situation where 100% of the money in the market's passive. So there has to be an equilibrium point where passive can only get so big, after which markets by definition have to be inefficient. So you have the big growth of passive investing, and the other one has been the huge growth of private capital. And just to kind of set the stage, like when I started in the markets 20 odd years ago, the only place you could raise large amounts of equity capital to fund big businesses like BHP or Coles or Woolies was public share market. So you'd list on the ASX, you'd list on the New York Stock Exchange, because it gave you access to the largest, the most sophisticated investors all around the world. You fast forward to today, and that's no longer the case. You have enormous pools of private equity money, private capital, willing and able to take any exciting company from the public markets into the private sphere. You can see on this chart here the impact that this has had. So this shows the number of companies listed on the US stock exchange over the last 30 years. And you can see the number of publicly listed companies in the US has nearly halved. And what this chart I don't think does justice to is obviously the fact that the US economy is 2 times larger over that 30-year period. At the same time, you've had this huge disappearance of public companies. The number of companies owned by private capital has gone up 500%. So from 2,000 private companies to over 11,000 private companies. And the reasons for this shift, they're not hard to understand. Regulation, litigation, endless public scrutiny and pressure. Joe Aston doesn't write clever little articles about private companies. And finally, the fact that, if you do bring an innovation to the public market, the passive industry will take it and copy it and, copy it for free relentlessly.
Yeah.
All of that has meant that it's a lot less exciting to raise money from public markets anymore. There's a much bigger preference, increasingly, for entrepreneurs, business developers to take private money if they can. And worse than the fact that a lot of public market companies are disappearing off the exchanges, and I think this is the problem for the future. You're getting less and less new startups coming to public markets. You used to have this sort of conveyor belt where new companies would come on the ASX, they'd grow on the ASX and they'd disappear and new companies would come. Today, increasingly, you're getting a lot less new companies joining the ASX to start with. If you're entrepreneur with your clever new idea now, you're much more inclined to go and get your startup money from a venture capital fund than from the ASX. And if your idea works, you're going to sell your business to a private equity firm. And the private equity industry will take it and extract all of the growth out of it over its life cycle. And this sounds a little dystopian, but I think it's true to a degree. A lot of these businesses only end up in the public markets these days once private equity's finished with them, once they're looking for someone to sell it to, once they're no longer excited about it. And certainly some of the best and most exciting companies never make it into public hands. Just to sort of reinforce this point, so this chart here shows the number of companies in the United States with revenues of over $100 million. So just to be clear, these are not mum and dad corner shops. These are big proper businesses that generate at least $100 million a year, US dollars a year in revenue. And you can see the proportion that are owned by private people, private capital, and the proportion that are listed on a public stock exchange. Less than 15% of all companies in the US of any real size are listed on a public stock exchange today. In Australia, the numbers are even worse. In Australia, it's less than 10%. Now, why does this matter, and what's this got to do with the passive industry that Emma and I say are intertwined? Well, passive investing really rests on two key propositions. The first is this idea that markets are largely efficient to begin with, and second is this concept that if you're a passive investor, what you need to do, the academic literature says, is that you want to own the market return, in inverted commas. And the market return is a wonky academic idea that basically says you want to own a diversified cross-section of the economy as a whole, weighted by its market size, because that is the best return you can hope to achieve after accounting for risk. And what that means in practice is that in Australia, if Commonwealth Bank is the biggest company in the Australian market, and it's 12% of the Australian economy, you put 12% of your investment into Commonwealth Bank. If BHP is the second biggest company in the Australian market, makes up 8% of the market, you put 8% of your investment into into BHP, and so on. Mm-hmm. The way that passive industry achieves those kind of outcomes is it creates portfolios that basically replicate share market indices, like the S&P 500 index we've been talking about, like the ASX 200 index. And of course, the problem that the passive industry is increasingly facing is that those indices are increasingly becoming irrelevant. You look at this pie chart here, and it's very hard with a straight face to say that you're owning a diversified cross-section of the US economy or the Australian economy. In the US, I wanted to go back to my S&P slide actually. In the US today, you have 7 tech stocks that make up 35% of the entire S&P 500 index. Now, there shouldn't be a financial advisor worth his salt saying that putting more than a third of your money into a group of very high risk, high reward tech stocks is appropriate for all people all of the time. In Australia, we have the same problem, a problem we've known about for a long period of time. Half of the ASX index is made up of a small handful of resource stocks and our banking stocks. Again, hardly a highly diversified snapshot of the economy as a whole. Emma's going to talk a little bit about why we don't think these trends are going to slow down anytime soon. But for me, I guess the great shame of this, and I think this is a consequence of regulation, and governments and regulators really need to think about what they're trying to achieve. You have a situation today where it's far more appealing, it's far easier to stay private than it is public, and that is basically forcing a lot of interesting companies out of the public sphere. And I think we're heading towards a world where increasingly retail investors are shut out of a lot of the opportunities that are available in the wider market because they stay private, and increasingly forced into investing into essentially passive solutions. There won't be much more on offer.
I mean, I am a little bit more positive in that I think, Vanguard is already in conversation with Harbourvest, who are one of the biggest private equity firms in the world. But let's just stick with this theme for a little while and just talk about what is available to us. So this chart here shows you that there are less than 9,000 global companies that you can invest into as an investor. And on the private side, there are more than 200,000 companies. What's more interesting, in my opinion, is the size of that. So the public markets is 87 trillion. And the private markets is 11 trillion. So you could look at that chart and kind of surmise or summarize that it's only just got going and it's only going to get bigger from here on in. Couple that with the fact that the private equity returns over time have just been so much better than the public markets. You really do start to sort of build a picture. This graph here shows in the 5, 10, 15, and 20 in the blue, it shows how much better the private markets have done versus those public markets. The exception there being the 3-year number, which has been driven by the Magnificent Seven and the incredible returns that we've all enjoyed over the last decade. The thing that I would ask, though, is would the Magnificent Seven go public today? I mean, we are all taking part in this incredible growth of the Mag 7 stocks. But all those companies listed 20, 25 years ago before this theme had kind of taken off. And my question is, would they go public today? And when you look at the current crop of high-tech, high-growth companies, they're all in the private space, OpenAI, SpaceX, TikTok, Stripe, Databricks. These 5 companies alone are worth more than the entire ASX 200 put together. And I think it really begs the question, would we have access to that sort of growth potential in the future? And it's just something that we're asking, we're thinking about, we're encouraging other investors to think about and just broaden the horizons when you talk about diversification. How diversified is your portfolio, and is it diversified only across the listed markets? Miles, can you talk a little bit about where we're at with GVF and why this might be a bit relevant to GVF?
Yeah, sure. Thanks, Emma. Yeah, I mean, it's kind of staggering if you think about it. Like 20 years ago, it would have been unheard of that you could have a company valued at $500 billion that was private and had no intention of going public and was completely happy being a private company. And OpenAI currently valued at $500 billion. A bit over a year ago, it was valued at less than 200. So you've had this huge value creation, all of it outside of the public markets. Why is that relevant to GVF? Well, I guess, one of the benefits that we have with the GVF portfolio is we're not constrained to tracking an index. It does require investors to give us a good degree of trust, something we're very respectful for. But we are relatively agnostic as to where we find value around the world. So we've been investing in private and public situations for the 10 years we've been running the fund, and in my previous firm for 10 years before that. We think that the private markets offer a fantastic source of diversification that we don't get in public markets as much anymore, and certainly a much broader range of opportunities. Today, just as a little data point for you, GVF actually owns stakes in those top 3 companies. So if you're a GVF shareholder today, you own a stake in OpenAI, if I can get the slides to work, SpaceX, and TikTok. We all in situations we found at exciting discounts to asset backing, all in situations where we have a path in place to unlock that value. And I think that's an important thing to emphasize here. When we invest into private situations, we're doing it through listed securities we've found around the world. We're not investing into a private equity fund that locks us up for 5 to 10 years. We've found some security, a holding company, a listed investment company, or a closed-ended fund or investment trust that owns stakes in those businesses, trading at a discount with a catalyst in place to unlock that value. And importantly, because these are listed securities, we can change our mind. We can trade back out of them. We've kind of fast-forwarded through this big theme today at rapid speed, but one other thing I just wanted to drop in is what we're talking about here in terms of huge amounts of the investable universe moving out of the reach of public markets into private markets. It's not just been happening in the space of equities. So we've talked a lot about private equity taking public market companies private. That same theme's been playing out in the debt space. And you would have seen a lot in Australia recently, people talking about private credit. So a lot of public debt investing, public bonds, those sorts of things has also been moving out of the realms of out of public markets. And again, that's always formed a key part of the GVF portfolio. So I do think it's an important differentiator for us. It helps us find more ways to build that all-weather, highly diversified portfolio, and helps us find a greater suite of opportunities.
And just to be clear, here on the screen is how we've been invested in this asset class since our IPO. So it's not new to us. And we've always taken advantage of the area, but you can see it's kind of ranged from 10 to 30% of the portfolio through time.
And I guess that's how it sort of ties into GVF. As I said, if you're a GVF holder today, you own a bit of OpenAI, the maker of ChatGPT. You own a little bit of TikTok, the infamous app that's got all the teenagers addicted. You own a bit of SpaceX. You're helping Elon Musk get to Mars. And I don't think there's a lot of publicly traded funds that can offer that kind of diversification.
And access. Yeah.
And that was all I had prepared today.
Perfect.